too often people become engrossed in their mistakes. When they keep a journal, a trading journal, that's all they write about is everything they did wrong.
Are those traders successful that are always writing down what they're doing wrong?
No,
Yeah.
never,
Yeah, that's what I assumed.
never. Because they're reinforcing the sense of being failures.
Welcome to the FundSeeder Rise podcast. I'm your host, Emanuel Balarie. Today, we're joined by Dr. Brett Steenbarger, one of the most respected trading psychologists in the world. Brett has spent decades coaching traders across hedge funds, prop firms, and systematic teams, helping them grow, handle uncertainty, and scale to managing outside capital. We'll talk about the mindset needed to evolve as a trader, the psychological differences between discretionary and systematic approaches, and how to prepare for the pressure that comes with larger AUM. So let's get started. Brett, thank you for joining us.
And thank you for having me, Emanuel.
So Brett, I know you've spent decades working with traders at every level, but I'm really curious the origin story for you of what first drew you to psychology. I know you've also been a professor, and what brought you into the world of trading and performance coaching?
Yeah, thank you. So what brought me to psychology? I declared a major in psychology relatively early in my undergraduate education at Duke University. I became involved with a study group that was run by the novelist philosopher Ayn Rand.
Oh, wow.
Yeah, it was a wow. There was really an emphasis on developing our heroic potential, becoming what we can become. And I found that inspiring and challenging. It's something that traditional psychology at that time was not focusing on. And working with people in performance fields was one way of putting that into practice. I developed an interest in trading and a fascination with markets, particularly equity markets, and saw that as an arena where we can develop our potentials and we can really do some great things. So eventually I brought those two together. But for many years, I was working separately as a professor of psychology. I was working at a medical school in Syracuse, New York, and then doing trading.
Yeah, that's fascinating. You know, Schwager,
Sure.
obviously, who you know of Market Wizards, and one of the things he talks about trading is, at least many of the Market Wizards had a passion when they were early in high school or even maybe late middle school of trading. I'm curious, before you went to Duke and started on this psychology career, what were you passionate about when you were in high school? What were the things that you were focused on?
Yeah, what I was passionate about in high school is basketball.
Is that why you went to Duke?
Exactly. Yes, it was a very big part of high school life, and I was curious about financial markets, but really did not delve into them. I can't say that I had an early passion about markets, and even now, the interest in markets is not so much an interest in trading as an interest in finding opportunity, in being creative, researching, seeing what other people don't see, and building something significant out of that research.
Interesting. So, we talked about this, I think, a few times on some of our other episodes, but I'm fascinated by the fact that you said, you were passionate about basketball, because you probably hear this a lot where there's almost this, I wouldn't say a correlation, but people bring up what an elite athlete and the mindset of an elite athlete is and how that maybe transfers over to an elite trader. Is that something that, just from your own personal passion of sports, that you have seen that there's that win mentality, right? That there is that desire to win that is almost, is it innate? Is it coachable?
Yeah, I remember Coach Bob Knight, who at the time was in Indiana, talked about how everyone has the desire to win. Not many people have the desire to prepare to win. And the thing I would see in common in the basketball world and in the trading world is that love of the process, that love of the game and preparing to win, learning new plays, executing new defenses, adapting to a different opponent, and practicing, 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 practicing. One of the exercises at Duke that I've spoken about in the past is that you couldn't go home from evening practice until you had made 10 free throws in a row. Yeah. And so you get to 6, you get to 7, you get to 8. Every muscle in your body is aching and wanting to go home. And it puts pressure on number 8, number 9, your 10th free throw. And people stayed for a long time to get their 10 in a row, but they loved it because it trained them to perform under pressure. And that's the similarity between money managers and people in sports. They love the opportunity to perform and to prepare to perform.
Yeah, that's it's a great thing, and I'm gonna just take a little bit of time because I have a bunch of other questions. I'm curious about the pressure to perform. So I have a daughter who's wants to be a really good pro soccer player. What I notice is that pressure goes two ways, right? There's that pressure where it helps you excel and perform, and then there's a pressure that actually just comes and it crumbles you. And I see this quite often actually with traders where they've been comfortable, maybe trading their own money, and now they're looking to transition, and those who thrive in that new environment excel, but many fail. Many fail of the pressure. So I know it's a long-winded question, but I'm curious when you look at pressure from a coaching and a psychology perspective, are there one or two things that you've seen elite traders do that use that towards their benefit versus, it has the opposite effect?
Yeah, in my earliest days working with traders in Chicago, I worked with market makers in the electronic futures, and I had traders I worked with who, at the end of a long day, their average holding period, by the way, was 6 minutes. At the end of a long day, what did they do? They replayed the market and went through bar by bar by bar, step by step by step, what they did, what they could have done, what they should have done. And learning, particularly with mistakes they made. And so they had a mindset of embracing mistakes as learning opportunities,
Yeah.
which is very different than a mindset of being threatened by mistakes. In fact, it was because of the drawdown that they would experience from a mistake that they were motivated to learn from it and not repeat it again. And I think that's part of an elite performance mindset is that everything is learning. And sometimes you do well and you can learn from what you do well. And sometimes you fall short and that too is learning.
Yeah, that's interesting. Again, I just keep on thinking of the sports analogy, where but like after a game, you watch game film and you go
That's
back
right.
to and you analyze it. And I think as you were talking about this, Brett, the things that come to my mind is when pressure negatively impacts you, you have a wrong mindset of thinking that you'll be perfect and that you can't make any mistakes. And so that's where pressure, like where people maybe think they have an opportunity to get the first outside capital, and then they think like, this is it. Like if I mess this up, then there'll not be I won't have any other opportunities to manage outside capital versus the ones that see it as just an evolution and there's more than enough opportunities and they can grow and learn. Would that be accurate? Like, would that from,
Absolutely. And there's a whole approach to applied psychology, a cognitive approach that tells us how we think about events determines how we end up feeling about those. And so if we become perfectionistic, if we feel like I have to do well or else, if I make a mistake, I'll look like a failure, I'll look like a fraud. You know, that internal conversation is what shapes our emotional experience of the performance. And so the really good performers want to succeed and they have a drive to succeed. And when they don't succeed, it's an even stronger drive to use that constructively to help them get better, get better, get better.
How many traders have you coached throughout the years?
Oh my goodness. I couldn't even begin to count. I've worked with a number of trading firms. What I don't do is I don't work with individual independent retail traders. That I haven't done. But I've worked with a number of proprietary trading firms, worked at a few investment banks, and I've worked with quite a few hedge funds.
So, what has surprised you the most about traders as people over the years? Something that maybe wasn't taught at Duke University, or it was just came as an evolution of you coaching. Like, what's the most surprising if you would categorize these traders as people that psychologically that surprised you?
Yeah, and that's changed over the years. I mean, working at hedge funds now is totally different from my earlier experience. Many of the funds have gotten quite large. They've become multi-strats, and the teams have become quite large. And so you have teams that have many different people who are participating in many different types of trading. And so working with a team is like what working with a fund was like in the past. There are just lots more moving parts. And team leaders end up being people managers as much as they are money managers. And so it's really changed working with traders because they're in this environment of participating in many different strategies and working with many different people doing many different things. It's not like the individual trader looking at charts and figuring out what to do in their market. It's not like that at all.
So it's evolved from that lone trader that's looking to, like you mentioned, look at the charts. Now there's a component of working with others, or knowing that other people are looking over your shoulder. There's a collaboration component to it.
It's become a team sport.
Interesting. And do you think that, I mean, I know it's a little bit of a difficult question, but is it beneficial? I mean, or like, or have you seen the trader himself excel in this team sport environment? And is that the evolution of it, or it's just the nature of the infrastructure and sort of the environment of the asset management industry, and you just have to adapt?
It is part of the industry. And uh, I think that for many traders, it offers a whole new dimension of experience because they can achieve success and fulfillment working with other people as well as working with ideas and markets. And so it becomes multidimensional. And for people with those skills and interests, that's quite positive.
Yeah. I know you mentioned, Brett, that you don't deal with retail traders, mostly those that work for prop firms and hedge funds. But I'm wondering if you have a story, maybe the greatest story of a trader. Maybe he just started trading at a prop firm who didn't manage a lot of money, I don't know, 100,000, $1 million in capital, and then went on to manage hundreds of millions of dollars and was able to make that leap. Have you seen that? Is that possible, or in your world, you haven't really focused on that?
That is the typical progression at most hedge funds. In other words, when you are hired, you might be hired as a junior analyst and you are helping research ideas that the team and the portfolio manager would make use of. And as you succeed, you widen your analytical purview and you become a senior analyst. And then if you develop good ideas that have worked well for the team, you may be given a sleeve of capital and you can actually trade and invest in your ideas at the same time that you're working as a senior analyst, which eventually leads you to become an assistant portfolio manager, managing more money, and eventually a portfolio manager having your own team in its own regard. So yes, that is a natural progression. What has been common is that people don't necessarily make that career progression all at the same firm. they often will jump to different firms and take on new and different roles in that growth process.
And when you've looked at the thousands that you've coached, I would imagine that there are some that haven't been able to make the leap, right? They've plateaued for whatever reason. And then others that have, besides just this idea of, going back and watching game film, if you will, or trying to get better and adapting to the situations that they're in, like what really differentiates the ones that you've seen again break through to the next level? Like is there yeah.
Yeah, they look at markets uniquely, and they approach markets creatively. They look for opportunity in different places than the average person does, and they're able to perceive unique opportunity as a result. The people who do the common kinds of analyses and the common kinds of preparation, the same way of looking at companies and modeling them, the same way of looking at charts and figuring out where things might go. I've never seen that to be successful. When someone has been distinctively successful, it's because they've done something distinctive. And creativity and the ability to find new opportunity is a big part of that.
That's good. It's the idea of edge, right? What separates you, or how are you looking at the markets uniquely or differently than everybody else, and how can you articulate it? But it's this evolution of evolving, not only as a person, it seems, but also in terms of the markets are evolving, and you're always looking for that unique way to get in or express your trade.
Yes, yes. And that's always evolving itself because what was unique at one time may not be now. And so you're always growing and doing new things, thinking about things in new ways. To give an example from my own trading, I became very interested in the work of John Ehlers, who is a quant who's done work on cycles within markets. And I began playing with cycles in markets and how those show up. I started looking at charts where time was not on the x-axis. Rather, each bar represented a fixed unit of volume. And as a result, the slower periods drew fewer bars and the busier periods drew more bars. And suddenly cycles became more regular in their appearance. And then I worked on ways of looking at how markets behave within their cycles and looking at the breadth of market moves as we go from cycle to cycle, and found some regularities. And so by the time I did all that research, I was really looking at markets differently, thinking about them differently, and that I found to be very, very helpful.
Do you think, as just a separate question, but in terms of AI, do you think that AI has the potential to replace traders, or because it's always evolving? This is your own personal opinion. I mean, it's a tool, but not something that 100% can replace a trader and his ability to be creative, if you will.
The AI may be replacing analysts because the AI can gather information in so much a broader way and more efficient way. So potentially the AI gives more information to the trader and more inputs to be creative with. And that can be very, very promising.
As a research tool or an analyst type of a, but not in terms of overarching a strategy that is trading in the market.
Right. In terms of strategies trading markets, you certainly can back test things and automate things using artificial intelligence, but at least the people I'm working with, that's not their dominant way of finding opportunity.
Yeah. So I have a few questions that came from a couple traders that are in the FundSeeder Rise cohort, and I wanted to get your take on this. And this comes under the topic of the difference between discretionary versus systematic traders. So this trader mentioned, if I put on a trade, I'm responsible for the outcome, zero exceptions. But as a systematic trader, I feel emotionally detached. If I follow the signals and have a bad month, it's part of the process. if I follow the signals, have a great month, it's also part of the process. How does the psychological responsibility differ between discretionary and systematic traders?
The systematic traders I've worked with spend a very large portion of their time researching and developing new ideas. So, for example, there are teams I've worked with who develop different signals, and those signals are not used in every single market environment. They work in certain environments, they don't work in other environments. So they have systems that trade in different environments, and then they have other systems that tell them what environment they're in. And when the systems move into different environments, they trade different systems, and they're always researching new systems, new ways of evaluating environments, and so forth. And so, in terms of personal responsibility, it's more for the creative output of the research, not so much for the outcome of particular trades.
Have you seen systematic traders maybe not be as, I mean, there'd be maybe a little bit more, less emotional burden, if you will, because they're systematic traders and they know they can't, they don't have to always be on their toes, if you feel, versus a global macro discretionary trader. Have you seen the difference between how they handle the day to day and their stress levels?
Yeah, I mean, when systems sometimes get into environments in which they're not built to perform in those environments.
Drawdowns.
Yeah, there may be something that comes up, like a COVID kind of situation, and suddenly there's a big reaction economically. There's a big reaction from monetary authorities, and it's not something that the systems are back tested for necessarily. That certainly causes stress, but it's different than the discretionary trader who's making buy decisions, sell decisions, and who may feel that stress at a more personal level, where it's their success, their failure, that kind of thing.
So for a systematic trader, I would imagine the parallel will be when they're in a drawdown or they're doubting whether their system is working. Would that be accurate? Is that the closest they
That's
get?
one source of stress
Yeah.
and uncertainty. Yeah, absolutely. Or if they are challenged to find the right data and, for the back testing and so forth, it's challenge in their research, not the challenge of up and down a P&L. When I was full-time at the medical school in Syracuse, I worked with faculty members, and these were often researchers in different medical fields, and they were conducting important research and complex research, and they experienced stresses and pressures, but those were very different than the stresses and pressures that practicing physicians felt in working with people who had difficult illnesses. So there's stress and pressure, but they have a different quality.
Yeah. That's good. The this other it's a good transition for stress and pressure, and that comes with managing other people's money. And the vision, of course, at FundSeeder is that we find traders that we think, have edge and they have some statistical performance, and they're looking to transition to the next step of managing other people's money, but they struggle at times with having conversation with the investors, perhaps the jump in AUM, maybe if they were, detached from the P&L because they're systematic traders, now they have this more relational interaction with an investor. What do you advise a trader who what can they do to psychologically prepare themselves from just trading their own capital to managing outside capital? And this could be both a systematic or a discretionary trader. It doesn't really matter. It's more of the preparation of their mindset.
Yeah, the problem is that me trading my capital is very different from me getting a lot of assets under management from outside investors, because with getting all that money from investors, I'm no longer a trader. I'm no longer trading that. I'm running portfolios. It's not like, okay, I buy 100 S&Ps in my own personal account. Well, now I'll buy 1,000 or 10,000, or that's not how portfolio management works. And so you are developing portfolios of different kinds of edges that are relatively uncorrelated that can perform in different kinds of environments. Many times, individual traders, if they are successful in looking to manage outside capital, they don't have that background in portfolio management. They don't know how to develop different ways of trading that can balance risk taking and produce a good Sharpe ratio for the overall portfolio. Systematic world, they do face something similar. As they gain more assets, there's a pressure to develop new and different systems that are diversified and that will perform across different market environments. And so that transition is an important one and a difficult one, going from trading an individual account and relatively small capital to managing large investments.
Why do you think it is so difficult?
It's a different skill set.
Okay.
Yeah, yeah. The individual trader, I mean, I work with individual traders like in the prop world, and one at a time they're trading this index or they're trading this stock, but typically they're trading a series of individual opportunities. They're not trading a basket of different opportunities and monitoring that so as to get balanced performance. I don't even think they would know how to do that in many cases. It's a different skill set. And so in terms of managing institutional capital, that's an important learning curve. And that's a big part of what people learn when they first join a hedge fund. They start out, like I mentioned, as an analyst, but they're observing portfolio management and how portfolios are constructed and how they're managed. And they gain that experience and they gain those skills.
Brett, the world has changed drastically, right? In the last, 10 years, 15 years, even the last 5 years since COVID. And the vision for FundSeeder has always been to give global traders an opportunity that have access perhaps to the same type of information, technology to get capital, scale, and compete against the bigger firms out there, the big names, the big hedge fund managers. But I have seen a struggle. I have seen a struggle of finding talented traders who might be performing well and then they struggle with this next step, if you will, of managing additional capital, transitioning from, like you mentioned, you said, a trader to a portfolio manager. How important is mentorship to this evolution of the process, right? Where if you're trading on the floor and you're in the Chicago Board of Trade, you join and they teach you. Now you're telling me the same thing in terms of you're starting as an analyst or you're at a prop firm and you might have this innate ability to put on trades, but you haven't even, you don't know how to transition to be a portfolio manager. How important is mentorship? And the second follow-up question is, can this mentorship only exist at some of these larger firms? Or are there other ways of transitioning and being mentored?
Mentorship is the number one way of developing expertise. And that's true across most performance fields, that we learn from people who coach us and people who teach us, and that's how we learn sports, and that's how we learn musical performance, and in markets. That's a big function of teams that offer role modeling and mentoring, so the more junior people develop those skills by seeing them day after day after day and internalizing them. I think for someone operating in relative isolation who doesn't get that mentoring, or that looks to social media for self-appointed gurus to be those mentors, it's a much harder climb in terms of the development of expertise. If I were a relatively junior person wanting to manage money, wanting to grow the capital I manage, the number one thing I would look for is a good mentor to work with.
Yeah. I have a 14-year-old son. And to your point about the social media, he's seen his dad and he's like, Dad, I want to be a trader. I want to learn. And one night I see him watching some FX video that got
Right.
millions of views. And I said, no, this is not the pathway, son. But I bring that up because it's a problem. There's a lot of misinformation out there, and it's increasing. And I'm glad you touched upon mentorship because I think that seems to work not only in trading but in any field, right? And I mean, even in the old days, right, where you passed on your skill set to your kids, if you will, right? There's something about not making those mistakes. So if you're a teenager today, if you're speaking to my son and you say, hey, these are the most important steps for you to have a shot to be a successful trader, what would those steps be? Would it be picking up a books and learning education? Would it be finding the right mentor? Would it be perhaps I'm just giving you some ideas. I'm sure you have options, but Jack talks about how, there's no holy grail in trading, and it's often tied into your personality and your makeup of emulating sort of that type of style. Would it be learning risk management? Like what are the foundational steps that a beginner can take to at least potentially go on this journey?
Yeah, I think the very beginning step, you find people who inspire you, and you can first do that through books that people have written, kind of like Mr. Schwager. Um, in reading about market wizards, it's a very high level kind of mentoring. It's learning from the example of others, and that's a start in that process. Ultimately, if I were a young person and I wanted to excel in trading and money management and so forth, I would join a firm that demonstrably is invested in training efforts, where there are multiple mentors at the firm. And that could be at an investment bank, it could be at a hedge fund, it could be at certain proprietary trading firms, but they're invested in training, and there are multiple mentors, and there are different teams that you could join and belong to and learn with and learn from. That's what I would look for.
Yeah, that's great counsel. Great counsel. So transitioning a little bit to this idea of perhaps unknown moments in a trader's life, which is navigating drawdowns or volatility. And drawdowns are emotionally taxing on every trader, right? It's where they just second guess themselves. They're asking themselves, like, "Am I doing right? What's happening? Will the investor pull the allocation?" What are some, through your years of coaching, Brett, some like practical techniques or frameworks that you recommend for traders to handle to handle during uncertainty or extended periods of loss?
Yeah, I'll just mention a couple. We often talk about the importance of conviction and confidence in trading, and yet, in some ways, one of our greatest risks is becoming overconfident in our ideas and not updating our ideas so that we see a market doing certain things. There seems to be momentum, and are we updating our view regularly? I often will ask a trader, okay, you have a profit in this position. If you were flat right here, right now, would you buy this stock? Would you buy this contract? So they have to look at it with fresh eyes. And that helps them not be overconfident and make decisions that adapt to changing market conditions. Many, many, many times those drawdowns occur because views get stale and there isn't that creative updating of what's going on in different markets and related markets. They're not eyes wide open. Once they have the trade, they're all in and they don't adapt to changing circumstances. Like right now, rates are doing some really interesting things. Look at rates in Asia. Look at rates in the US. Look at the possible future course of rates depending on who we get as a Federal Reserve chair. Well, if rates suddenly become more volatile and become more differentiated around the world, how might that affect currencies? How might that affect economies? How might that affect equity markets, et cetera, et cetera, et cetera? So much of adapting to day-to-day situations and avoiding drawdowns is updating views, asking new questions, looking at new things. That's what the good teams do.
Yeah. Is there, I was speaking to someone else about like almost that like internal discomfort, if you will, or stress that comes up at times that is an innate signal, perhaps, that your body is telling you maybe about a trade, maybe about a market. I mean, you could call it maybe an intuition, the gut feeling. Like, have you, from the doctor component in studying, a lot of this, like, is this a common theme where you can perhaps be more in tune to your body and what you're sensing, whether there's a change in the system, whether you should put on the trade or not?
Yeah. Intuition's the right word for that.
Yeah.
That we notice something, we're seeing something different, we're sensing it, we haven't fully identified it. That intuition by itself is not a firm conclusion. That's not a factual basis for making decisions, but it's often a worthwhile hypothesis.
Pay attention to it.
Pay attention to it. Often in my own trading, something will happen. We start out the morning strong, and let's say in stock index futures, and then it kind of fades away. And I'll say to myself, wait a minute, that shouldn't have happened. If we're in a good bull move, that shouldn't have happened. That's not right. And suddenly that gets me looking at things in a different way. But at that moment, when I'm sensing that something's not right, I haven't fully identified what's changed, and I need to dig deeper to come up with those conceptual understandings.
Yeah, that's good. Going back to the investor communication, and I know I mean, I don't think you don't deal with investors or allocators, right? That's not something that you've done, but it's still the same idea and the perception that now someone is looking over your shoulder and you're focused as a trader, maybe you're focused on the markets, you have your system, but you have someone looking over your shoulder. Is that just part of the process where you're gonna you should expect that you're gonna be thinking about that person, or are there guardrails or certain things that you could put in mind where it's like, okay, look, I'm focused on just the markets. That's a separate part of the conversation, and I'm not going to be impacted by Stephen Cohen looking, to see if I generated returns or my investor, et cetera.
Yeah, no, you have to be cognizant of your investors looking. I mean, that's what
Yeah.
you're investing their capital. That's who you're working for. Particularly Steve, I would be very cognizant of. But um, y- you know, each investor, each fund has its own risk guidelines. And over the years, those have become tighter. And so you become aware of what drawdowns are acceptable, what drawdowns aren't, and you become much more cognizant of how you can avoid drawdowns by trading different opportunities and being really diversified, so that some ideas may work in one environment, some ideas may work in another environment, but across environments, something will always be working. Much of the demand among investors is for a good Sharpe ratio. They're not necessarily looking for someone who will max out absolute returns. They're looking for someone who whose average win is greater than their average loss, who has a relatively smooth equity curve. Basically, investors, particularly larger investors, they don't want drama. They want steady returns. And so that means we have to be steady in managing their money, and we have to have portfolio construction methods that give us that steadiness.
Yeah, that goes back to what you said about transitioning from being a trader to being a portfolio manager. I think for emerging managers that are taking more the non-prop, non-multi-manager pathway, most investors are not having that conversation with them in terms of those guardrails, which are like what I could, this is what you should expect in terms of my expectations of volatility or drawdown or leverage, because they have multiple investors.
Mhm.
And so then the stress probably is even greater because they haven't communicated and they're thinking like, what is my investor thinking, instead of actually outlining it from the beginning, or for themselves saying, hey, this is the frameworks that I'm going to judge myself based on these risk measures. Does that make sense? And is that like,
That last part of what you said makes huge sense, Emmanuel, that you have to develop those guidelines for yourself. That if my goal is to produce relatively smooth returns, how can I make sure I do that? And the odds are pretty good that that's going to satisfy the vast majority of investors.
that's great. That's great. Okay, so another question that was posed in your book, The Psychology of Trading, you wrote, a problem is a solution that has lost its validity. Can you unpack this idea and explain what you meant?
Yes. So as it turns out, I have a book coming out in February.
Excellent.
Yeah. It's a book that integrates what's called positive psychology with trading psychology. And the whole idea of positive psychology is that we grow and develop not simply by correcting our flaws and our mistakes, but by identifying and building upon our strengths and really understanding what we do well and building processes around that. Markets are always changing. And so, what was a strength perhaps in one set of market conditions, now all of a sudden we've outgrown it. It's it's no longer a strength. And so we're always having to update what we do and why we do it because markets are dynamic. But the idea is if we identify that the market is in a particular regime, you want to ask yourself, how have I successfully traded that regime in the past? What have I done that's worked in the past? How can I do more of that? How can I build a process around that? So that's building on strengths rather than trying to correct mistakes.
Yeah. So again, the parallel to sports, it's almost, you have different plays and different playbooks, if you will, for different teams, or, different, like for football, run defense and pass defense. So, I'm thinking about, again, giving this idea of transitioning and moving to the next levels and managing outside capital. If you see a regime shifting and your investors have allocated capital based on a certain regime, what's the right thing to do of how you can communicate this to your investor and still with confidence, versus them just deciding to pull the capital because, well, if the trading market has shifted and it's no longer ideal for your strategy. I don't know if that makes sense what I'm trying to, but like, how do you communicate this to your investors where they don't pull the capital because now you're telling them that the structure is totally different?
Yeah, it's a great question. Excuse me. And it's why larger hedge funds have IR, investor relations departments, because they're regularly communicating with their investors. And they're saying, here's what we're seeing, here's what we're doing, here's why we're doing what we're doing. Let's say that you saw a particularly risky environment around the corner and you decide to pull back from risk taking. You're not going to be as highly invested because you anticipate considerable volatility and uncertainty. You proactively communicate that to investors. Here's what we're doing. Here's why we're doing it. We're being prudent stewards of your capital. Here's how we are doing it. And that builds confidence in a trader, in a portfolio manager from the investor.
Yeah, that makes sense. The communication, helping them understand, what's going on in your head, and that transparency, because again, you are a steward of their capital. What are your thoughts? Just, for you hear and you see on the news often about talent wars and, the lack of talent or the competition for the larger talent. Like, you know, where do you see the world transitioning in the next 10 years with this up and coming new generation of successful traders?
Well, there is a lot of competition for talent, particularly experienced talent. So I think part of what's interesting about what the work you're doing is you're giving traders this experience so that they can possibly participate with these larger money management firms as experienced people and be recruited as experienced people. And so we're seeing more and more of that there is active hiring, but They're hiring for specific talents, specific expertise. I think what you're developing is a little bit of what happens in major league sports, where there are developmental leagues and the people who do well can go into the major leagues, can go into the pros. And that's hasn't been done much in the past. And that's a very promising area.
Yeah, the point, and you mentioned, and this will be my last thought, and is you mentioned that there is a high demand for established talent or talent that's developed. I don't know the exact words you used. And that's probably, it's almost like if you've read the book The Innovator's Dilemma, where you have to perform for the bigger companies, like you got to perform now on this quarter, and so you can't take the risk on the smaller traders themselves, where there's going to be that learning curve, that mentorship curve, that process curve, that evolution curve that traders have to go through, and as a result, it's where we are today. But to your point, and this is the vision and dream of FundSeeder, if we are the minor leagues and we start thinking in advance of setting up a baseball farm system in Dominican Republic or in Panama, like at a certain point, then that'll become something that's viable.
Absolutely. And the whole purpose of that quote unquote minor league is to help people make the transition from becoming traders of individual assets to being asset managers, where they're developing multiple positions and whole portfolios and learning to manage the risk of that. That would be tremendously valuable.
Brett, any other parting words of wisdom for aspiring traders looking to scale, looking to grow, that you would say could be helpful?
Yeah, well, based on this new book that will be coming out in February on the positive psychology of trading, an idea that I toss out is that at some times, in some ways, you are already the trader you want to become. At some times, and some points, you do things really well. You do things greatly. You want to reverse engineer your successes. How did I do that? What did I look at? How did I think about it? How did I manage that risk? Learn from your successes. Those become best practices, and those ground your success going forward.
So learn from your successes, focus on the positive elements of what you're good at, what got you where you are today, and not so much in terms of focusing on your negatives or what you lack and trying to improve that.
You definitely want to learn from your mistakes, but too often people become engrossed in their mistakes. When they keep a journal, a trading journal, that's all they write about is everything they did wrong.
Are those traders successful that are always writing down what they're doing wrong?
No,
Yeah.
never,
Yeah, that's what I assume.
never. Because they're reinforcing the sense of being failures.
Celebrating wins or focusing on the things that brought them and remembering their days where they shot the 3-pointer in high school, right?
Yeah, learning from your strengths. Yep.
Brett, thank you so much. If somebody wants, I know you mentioned your book, but if somebody wants to learn more about you, is there somewhere where they could go? I think you have a website.
Yeah, TraderFeed, TraderFeed.blogspot.com. That's my blog site, and I post regularly there.
Well, I appreciate it, Brett. Thank you again, and thank you everyone for listening to the FundSeeder Rise podcast.
Thanks for having me.
Thank you for joining us on the FundSeeder Rise podcast, where we spotlight exceptional independent traders from around the world and explore the future of active money management. To learn more about FundSeeder, our mission, and how we support emerging managers globally, please visit us at fundseeder.com. The information shared in this episode is provided for educational and informational purposes only and should not be considered investment advice or an offer or solicitation to invest in any fund or trading program. Trading futures and other derivatives involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Until next time, stay curious, stay disciplined, and keep rising.